Matthew McConaughey coming to MC to introduce me? Or no? Okay. Sorry. Hi, everyone. I'm Lindsay Cohen, the Chief Marketing Officer at Align Income Share Funding. Before I tell you about Align, I wanted to tell you about a quick realization that I had. So I've been out of college for 16 years and out of business school for 10, but it wasn't until just recently that I realized how good students really have had it. You get to wake up at 2 o'clock in the afternoon. You get to take a wide variety of classes, some of which are actually interesting. And you get to do all of this within a close proximity of a lot of your friends. There was one rather detrimental part about being a student, though, and that was all the debt that you amassed. But students today have an increasing amount of access to income share agreements in order to save them from that debt. You may have heard about income share agreements, or ISAs, from the Backup Boiler program that was launched by Purdue University a few years ago, or the growing number of coding schools that are using ISAs as an alternative financing tool. If you still don't know about ISAs, that's okay. I'll go into them in a bit more detail in a bit. But for now, know that an income share agreement or an ISA is the ability for someone to borrow money today in exchange for a fixed percentage of their income over a set period of time. At Align, we believe that ISAs shouldn't be limited to just students, and that working adults would also benefit from this novel structure. And here's why. Let's think about an unexpected $500 expense. Maybe someone gets into a car accident and has to pay for her deductible for the repairs, or someone's oven broke and they have to replace it. Well, only 4 out of 10 Americans have $500 in savings to cover this expense, leaving 6 in 10 to have to scramble to come up with the money. 2 of those 6 would turn to a credit card that they would pay against for the next few months, and the remaining 4, they would have to turn to a loan or cut spending to amass $500 over the coming months. So you can see that the margin of error with many Americans' budgets is razor thin. For many households, the money balance is incredibly delicate. So what happens when someone who's living in this reality experiences a drop in their income? Maybe their hours are cut at work because people don't shop in retail stores anymore, or maybe they had to take a few months off to care for a relative. Income share agreements provide people the chance to get funds to cover these unexpected costs, all while not disrupting this very delicate balance. This structure of an ISA is inherently more flexible than a traditional loan because payments fluctuate with the customer's income. Let's take a quick look at an example of how an ISA works. This is a plot of what happens after a customer borrows money under 2 scenarios. One, under a traditional personal loan shown by the gray line, and the second by using an ISA shown by the blue line. The y-axis represents the payment amount expected, and the x-axis represents time. The gray line represents what payments would be due on a loan, a consistent dollar amount each month, regardless of what happens to this person's income, which is denoted by the purple line. When the customer agreed to their loan or ISA, they did it based on his income at that moment in time. He could afford that monthly payment based on that income level. Unfortunately, a few months later, that person experiences a decrease in his hours, and he's bringing home less money. And then, even more unfortunately, a few months later, he loses that job, taking his income down to 0 for a few months. With a loan, a lender still expects a payment. With an ISA, when someone's income decreases, so does their payment. And if they become unemployed, we don't expect a payment at all. And we don't expect that payment to ever be made up. It's just forgiven. Then, when someone is able to get back on their feet, payments resume. And if a person gets a raise, their payments go up also, but they only pay us that same low fixed percentage of that raise. We also offer our customers the ability to buy out their contract early without any penalty. We think that an income share agreement is a win-win proposition. Customers benefit from this personalized structure that is more flexible, and we benefit from lower default rates. because when our customers aren't able to pay because of a change to their income, we adapt, whereas a traditional lender would still expect that same payment, and after a few missed payments, that customer ends up in default. The ISA structure also protects our return on capital from interest rate and inflation risk. The real benefit to both parties is that our interests are aligned. When our customer experiences a financial hardship, we share in that burden and forgive payments when warranted. In return, we also share a small portion of our customer's success, which we believe is a fair price for the baked-in insurance an ISA provides. Align currently offers ISAs to working adults in the United States who are looking for up to $12,500 to fill their financing gap for whatever reason. Our average income share agreement contract is for $5,300 with a term length just over 3.5 years at a rate of 6% of a customer's pay. Align's customers are in the near prime segment of the credit spectrum and are on average 40 years old with an annual salary of $65,000 a year, and most are college graduates. Align's customers typically use ISAs to consolidate more expensive debt, pay for home repairs, or pay medical expenses. But we don't restrict the use of funds. We've also seen customers take out ISAs to put solar panels in their house or to pay for their wedding. While ISAs in the education space have been gaining steam lately, Align began originating ISAs to working adults in 2011, and since then we've grown to 20 employees in our Chicago headquarters. After testing out the product for a few months, we raised our first series of external financing that we deployed into ISAs and used the money to acquire new customers. In 2016, we closed our most significant financing to date, a $6 million Series A in operating capital, an additional $25 million financing facility that is expandable to $100 million. And in 2 years, we've grown significantly, but we still have ample powder to deploy. We're also on track this month to have our first $1 million month. We're currently raising a Series B to fuel our growth. We'll use these funds to build out our technology and use additional partnerships, allowing us to reach even more people with this exciting and truly innovative new product. Thank you so much for listening, and if you have any questions about ISAs in the real world, let's chat.